Hey everyone, this is Yossi. I run a small investment firm that specializes in REIT investing, and recently one of you asked me if I could only own 4 REITs, which one would it be? I thought that this was an interesting question because a lot of you may not have enough capital to build a well-diversified portfolio of 20 to 25 REITs on day one, and so I understand that you need to get started somewhere. 4 REITs is a good start. It can build the base of your portfolio, and you can then seek to gradually expand the portfolio and diversify further as new capital becomes available. But before I get going, I want to clarify still that I wouldn't want to own just 4 REITs over the long run, because that's simply not enough diversification. If you own 4 REITs and one of them performs poorly, it's going to be very hard to make up for the losses with your 3 remaining positions because you're simply too heavily concentrated. Because of this, if I could only own 4 REITs, my selection would also be very different than if I could own a portfolio of 20 to 25 REITs, because you're not able to take as much risk, and so I would probably focus more on safer REITs that have a predictable path to long-term outperformance with limited risk. I would stay away from more speculative plays like Medical Properties Trust or Unity Group or New Lake Capital Partners, which I've also covered quite extensively on this channel. These are potentially attractive REIT investment opportunities for more aggressive investors, but if you can only own 4 REITs, you probably want to stick to blue chip companies that are much safer than those. So what are the 4 REITs that I would select? The first one that I want to discuss here is called Camden Property Trust, ticker symbol CPT. I think that Camden offers arguably the best risk reward in the apartment REIT sector today. It's not the cheapest, it's not the safest, it's not the fastest growing, but it offers the best combination of value, yield, growth, and safety in today's environment. Starting with value, the company is today priced at an implied cap rate of roughly 6.7%, which equates to a roughly 35% discount to its net asset value, and that's really not so different from the valuations of its smaller and riskier peers that are more heavily leveraged, like BSR Group or Next Point Residential. These REITs are a bit cheaper, but really the difference is not significant. However, Camden is obviously a much higher quality company. It has a larger scale, it has a blue chip reputation, it has an amazing track record, it has an A-rated balance sheet, which obviously has value. It's able to develop its own properties, which also allows it to grow at a faster pace. And despite that, its valuation is not much higher. It is a bit more expensive, but the spread is historically small. And so for this reason, I think that it makes sense to pay the small premium today. Then concerning the safety of the REIT, you could make an argument that some of its peers like Mid-America Apartment Communities, ticker symbol MAA, is a bit safer than Camden because it has a bit less leverage on its balance sheet. But again, here the difference really isn't that significant. As I mentioned earlier, Camden has also an A- credit rating, so it has a strong balance sheet. And you could also argue in favor of Camden in that it focuses more on affordable Class B properties, which are typically safer than the Class A new build properties which Mid-America is focusing on. Those are a bit more cyclical, they are more heavily impacted by the oversupply today. And so yes, I agree that Mid-America is a bit safer, but I think that Camden is a relatively safe and defensive REIT as well. And so again, the difference is not significant here, but despite that, Camden is a lot cheaper at the moment. And then finally, coming to growth, today Camden is at a disadvantage compared to the apartment REITs that focus on coastal markets, because Camden mostly focuses on Sunbelt markets, and those are impacted by oversupply at the moment. But despite that, even here the difference really isn't significant. If you look at the guidances of various REITs for 2024, companies like Avalon Bay or Equity Residential that focus on coastal markets are today guiding for only slight growth on a same property basis, maybe a 1% same property NOI growth rate. In comparison, Camden is pricing for 0% growth rate, so despite the oversupply, it's not bleeding at all. It's still able to maintain its same property NOI level, and so despite that, it's priced at a very large discount compared to these coastal REITs, and I think that the discount is excessive today. In the coming years, I think that this oversupply is going to turn into undersupply, and the market's narrative is going to reshift to the rapid growth of the Sunbelt markets, where population and job growth is much greater than in the coastal markets. And once again, Camden is probably going to regain a premium valuation. So to recap, right now you can buy Camden at a similar valuation as its smaller, riskier, highly leveraged peers. Its valuation is a bit lower than that of Camden, but I think it should be a bit higher, and it's a lot lower than that of coastal apartment American REITs when I think it should be only a slightly bit lower. Just to return to its net asset value estimate, its share price would need to rise by about 50%, while you wait to earn a 4.2% dividend yield, and the REIT also retains a lot of cash flow to keep reinvesting in growth and create value for shareholders. Overall, I think that the risk reward is very attractive, and so this will be one of the REITs that I would want to own out of these 4 that I will discuss in today's video. Before I go into the second REIT, I want to let you know that I plan to soon release some exclusive CEO interviews with some of my favorite REIT investment opportunities on this YouTube channel, so make sure to subscribe to the channel if you don't want to miss those. Then the second REIT that I would want to own is called Big Yellow Group, ticker symbol BYG in the UK and BYLOF in the US. I've discussed this REIT quite a few times on this channel, and I'm discussing it once more because I think that this is really a no-brainer. I started investing in Big Yellow now nearly 10 years ago. I bought more shares at every dip, and it's been one of my most successful investments. And just recently, I again bought more shares because I think that the company has a clear path to above average returns with below average risk, and that's what active investing is all about. To understand why I'm so excited about Big Yellow, you need to take a step back here and ask yourself what was the most rewarding property sector over the past 30 years in the US. The answer is self-storage. Self-storage REITs generated nearly 20% average annual total returns over the past 30 years. And despite earning the highest returns, they did so with the least volatility. And so this is really an exceptional performance. They achieved this because they were able to earn very large spreads over their cost of capital by developing new properties at 8, 9 to 10% initial yield on cost. They would fund those with an average cost of capital about 5%, so the spreads were truly exceptional at about 500 basis points. In comparison, traditional REITs like Realty Income would be happy to get 100 to 200 basis point spread, so these self-storage REITs were able to grow a lot faster because the spreads were truly exceptional. However, the American self-storage market is today much more competitive. New facilities have been built all over the nation. You can literally see one at every busy intersection. And so I think that the future economics are going to deteriorate quite a bit because, again, more supply, the demand hasn't grown so much. And so naturally, simple rules of economics will tell you that returns are going to decrease going forward. However, this brings us to Big Yellow. It's the leader in the UK. And I think that the European self-storage market is still today 20, 30 years behind the US, and they have now an opportunity to replicate these strong historic returns that American REITs earned in the past. Big Yellow is the leader in the UK. It's been investing in this segment of the property market for about 20 years, and it's been massively successful. It has generated roughly 16% average annual total returns with shareholders, and that's despite suffering greatly during the great financial crisis because it was over leveraged back then. If you adjust for that, actually, its average annual total returns have historically been close to those of American REITs at nearly 20%. But the difference here is that I think that they can keep this going for a long time to come because still today in the UK there's about 10 times less storage space per capita than in the US. Eventually they can also expand into continental Europe, which has even less. There's about 40 times less self-storage space per capita in places like France and Germany than in the US. And yet the concept is now rapidly growing in popularity, and so they have a lot of development opportunities. They currently have 11 of them underway. This is expected to expand the size of their portfolio, of their square footage, by about 15 to 20%, so it's very significant. And at the same time, they are looking to buy new sites to build additional properties. They're currently able to earn roughly 9% initial yields on these new assets. The cost of capital is about 5 to 6%, and so again, yeah, there's a large spread here, and I expect this to result in strong growth in the coming years. Historically, the REIT has been able to grow its FFO per share by over 10% annually, which is really exceptional for REIT. And despite that, today priced at a roughly 4.5% dividend yield, about 17 times FFO, which is very reasonable for REIT that has such growth prospects and defensive fundamentals. I didn't mention this yet, but the REIT also has very little leverage. Its LTV, it's only about 15%, so it's not heavily impacted by the recent surge in interest rates. On the contrary, if it wanted to accelerate its growth going forward, it could expand its leverage and take on even more investment projects. So for these reasons, this is an easy pick for me. It has defensive fundamentals, it has a great story that has already played out in another region of the world, and it's now simply replicating it in Europe. And so I see an easy path to long-term outperformance with below average risk. I wouldn't expect any major upside tomorrow, but over the long run, I would expect strong returns. Hey, before I go into the third REIT, if you think that this content is valuable, I really appreciate it if you'll click the like button. That helps me a lot to grow this channel, to put it in front of more people. Thank you so much in advance. The third REIT that I'm going to discuss now. I've also mentioned quite a few times on this channel, but bear with me. I'm going to try to cover it from a different angle. And this is one of my biggest REIT investments. It's called Essential Properties Realty Trust, ticker symbol EPRT. Before I became a REIT analyst, I used to work in private equity real estate in Texas, and one of our favorite type of investments were net lease properties. These are typically freestanding, single-tenant retail properties that are service-oriented. Good examples here would be Dollar General grocery stores, Chevron gas stations, 7-Eleven convenience stores, Walgreens pharmacies. You get the point, this type of properties, and they can be very attractive investments because the lease is typically structured in a way that's very favorable to the landlord. Typically, the lease will be very long with an initial term of about 15 years and several 5-year extensions. During this lease term, the tenant will be responsible for every property expenses, including even the property taxes, the insurance, the maintenance of the property even. And then finally, the rent will be increased every year very consistently by 1 to 2%. This may not seem like much, but again, remember that the tenant is covering all property expenses. So this is real growth that really falls down to your bottom line. And so then you would buy these properties at a 6 to 7% cap rate. That this was back in 2016. Now the cap rates have expanded a bit because interest rates have surged. But let's say you would buy a property at a 7% cap rate, you would finance half of that with debt. That would bring your initial yield on cost to about 10%. Add a bit of growth and appreciation to that, and you will get a clear path to 12 to 15% annual total returns from a relatively safe investment that requires very little management. And for this reason, this was really one of my favorite types of real estate investments. A very popular REIT in this segment of the property market is called Realty Income. Its ticker symbol is O. It's also known as the monthly dividend company. It's very popular. It's one of the most popular REITs in the world, but I think that it's a bit overrated simply because there are some even better opportunities in its peer group. And really my favorite here is called Essential Properties Realty Trust because it has a unique business model that has historically been able to generate above average returns with below average risk. It went public about 5 years ago, and since then it's been able to generate roughly 4 times higher total returns than Realty Income, and that's despite not taking much more risk. And so the end result is that it's earning much better risk to reward for its shareholders. There are really 2 main reasons why it's so much more rewarding. The first thing is that it's much smaller in size, and this is important for a net lease REIT because it means that every new acquisition is going to have a much bigger impact on the bottom line. It will really move the needle. This is a problem that Realty Income is today facing because they've really become massive over the years. They have a market cap of about 50 billion, and so it's tough for them to find enough deal to really truly move the needle and keep growing their FFO per share at a pace that would allow them to keep up with their historic returns. And then the second advantage of EPRT is that it's able to get larger spreads on its new investments because of its unique approach to net lease investing. Here you need to understand that most net lease investors will target properties that are occupied by big name tenants that have strong credit ratings. A good example here would be Dollar General convenience stores. But the downside of this is that there is a lot of competition for these assets, and as a result, cap rates are a bit lower, and the tenant also has more bargaining power with landlords, and so typically the lease will not be quite as favorable to the landlord. So instead of targeting these properties which are, very desirable, targeted by a lot of investors, EPRT is taking a niche approach and it's going after smaller middle market tenants that are not getting nearly as much attention. This allows it to buy properties at higher cap rates. So earlier we talked about 6 to 7% cap rates. EPRT in the last quarter, it got closer to 8% cap rates, and so far this year it's getting even slightly above 8%, which is very attractive. And then on top of that, it's getting even stronger lease terms, which then allow it to mitigate risks, because yes, it is true that smaller tenants have lower credit quality, but the flip side of things is that now it's able to structure stronger contracts that will mitigate risks because again, the tenant doesn't have as much bargaining power as these bigger companies, and so it will typically get master lease protections, corporate guarantees. It will be a true triple net lease, so the tenant will truly be responsible for all expenses, whereas sometimes these big tenants will be able to ask for some concessions. Perhaps the landlord may be responsible for the parking lot and the roof, things like that. Now, in the case of EPRT, these are true triple net leases. Typically, the lease term also will be longer, so instead of being at 10 to 15 years, it might be 15 to 20 years. You get the point. EPRT is able to get more rewarding leases that are also safer, and as a result, it's earning higher risk-adjusted returns for its shareholders. I think that the best proof of this is how it performed during the pandemic. This was really the worst possible crisis for a net lease REIT when you think about about it because we were dealing with significant restrictions. In some cases, some properties even had to shut down completely, and so tenants were not able to pay their rent. But despite that, EPRT recovered really quickly. It kept on growing faster than peers like Realty Income, even through this crisis. And so this is really the best proof that this model is not much riskier than that of other net lease REITs, and yet it's a lot more rewarding. I expect these strong returns to continue for many years to come, and so for this reason I invest heavily in this REIT. The simple math is that today's price at a 4.5% cap rate, it's able to grow at a mid to high single-digit growth rate every year. And then on top of that, perhaps you had a bit of upside, 10 to 20% as interest rates return to lower levels over the coming years. And so all of this combined together should get you to 12 to 15% average annual total returns over the coming years. That's my expectations. So now we're gonna go to the last REIT. Before that, I want to remind you that you can access my entire real money REIT portfolio and all my trade alerts in real time by joining my REIT newsletter, High Yield Landlord, for a 2-week free trial. This is a real free trial. You won't be charged anything in the first 14 days. So if you want to just come in, see my portfolio, and then cancel and leave, that's perfectly fine with me. I hope to see you there. And then the last REIT I will discuss here is actually a fairly new holding of mine. I've never discussed it on this channel. We've covered it quite extensively at my newsletter, High Yield Landlord. It's called Vesta, ticker symbol is VTMX. If I could only own 4 REITs, I would want to also own some industrial real estate, and I think that the best opportunity today is arguably in Mexico. Vesta is the first and only Mexican REIT to be listed on the New York Stock Exchange. It owns a vast portfolio of Class A industrial properties in some of the fastest growing regions of Mexico, and then on top of that, it's also developing a lot of new properties and expected to earn large spreads over its cost of capital. We think that the REIT is very well positioned to keep growing at a rapid pace over the coming years because it benefits a lot from the growing trend of nearshoring. For the first time last year, Mexico actually overtook China as the biggest source of imported goods to the US, and this trade relationship between the US and Mexico expected to keep growing at a rapid pace over the coming years because, again, nearshoring has really become popular following the pandemic because companies learned that there's significant indirect cost to having big parts of your supply chains really far away from your end consumer, and so they'd rather now bring it closer, and Mexico is a great place because of the geographic proximity. But on top of that, also these days labor is a lot cheaper in Mexico than in China. It's also cheaper to then transport the goods to your end consumers, and there are many other reasons that we've covered in our report at High Yield Landlord for why this trade relationship is expected to continue in a positive direction that will benefit Vesta going forward. And so this provides Vesta a great opportunity to keep growing its rents, which are today still far lower than what you would charge for comparable properties in the US. Those rents are probably going to keep on rising in the coming years because there's so much demand for these properties. And then on top of that, it's able to build new properties, and it's expected to earn very high initial yields on cost of about 10%. And so one major advantage of Vesta here that's very attractive to me is that it's because it's listed in the US, it's now able to access capital in the US at a reasonable cost, and it's then able to invest it in Mexico, where returns are higher than in a developed country like the US. And so the spreads are truly exceptional, and that should allow them to keep growing the FFO per share at a rapid pace over the coming years. That's all I had for you today. Once more, if you want to access my full portfolio, there's a link to a 2-week free trial in the description of this video. And otherwise, please let me know in the comment section what you would do differently. If you could only own 4 REITs, let me know which one it would be. I'll be happy to discuss with you in the comment section. And otherwise, thanks again for all your support. I really appreciate it, and see you at my next one. Bye-bye.